Well, Adam, thank you very much for being on the podcast.
Great to be here. Thanks for inviting me on.
Yeah, I see you have this gaming chair, and I just have to ask you about GameStop because you might be curious and might know some stuff that I don't know. Tell me about it. What do you think? What's going on, and what's your take on that?
Yeah, sure. So no, despite the chair, I have the chair for comfort. Not it does not. Uh, I'm not a gamer, but someone suggested getting a gaming chair for comfort, and I like it. I mean, I spend a lot of time at the computer, but so yeah, I mean, obviously that's hot on the news today with everything going on with GameStop. It's just to me, the same sort of thing. It feels like 20 years ago. I mean, I have much more of an awareness today in the market than I did 20 or 22 years ago. But it just feels like sort of the same old thing. Whether it was the AOL chat rooms or what have you of 20 years ago, that's just the Reddit, the Wall Street bets of today. And markets go crazy from time to time, and this seems like one of those things. So hopefully none of your listeners got caught up in it, and it's one of those things just to take a lesson from and kind of watch from the sidelines. But the best thing to do is just keep your head down and focus on the value investing and remembering that you're buying a business.
Yeah, value investing is definitely the opposite spectrum of what's happening with GameStop. Like, how did you discover it? Like, what's your path to it?
So I come from a family of business owners. So my grandfather had a tree business. My father had a trucking company and a home building business. So business to me was just sort of always in my life. And I had a firewood cutting business. I sold firewood through high school and in college, and I also had a welding business, believe it or not. And so it just reading about business and being aware of business. Buffett is just so omnipresent in the business world, let alone the investing community, that you're bound to come into his orbit at some point. And it just instantly stuck. I mean, that comment that he has about reading Graham and the scales falling from his eyes. I mean, I felt the same way. This guy just makes sense. So uh, here I am now writing about it.
How many Berkshire Hathaway meetings have you attended?
Well, if you count, actually, if you can kind of see my background here, I've framed all my meeting passes. My first meeting was in 2012. So I guess this would have been my 10th year. Uh, but I guess, I tuned in live last year. I plan to tune in live this year in May for the broadcast. So I guess I'll count it as 10, but with a little asterisk there that I was sitting in at home.
And obviously, we're talking today because you wrote the book, the Complete Financial History of Berkshire Hathaway. There are quite a few books written about Buffett, and I think there are one or two about Berkshire Hathaway itself. How is this one different?
Yeah, it's a great question. In fact, it's probably the first question that comes to a lot of people, and the first question you should ask, right? Um, my friend Chris Bloomstrand, who wrote the forward to the book, he actually looked up on the Library of Congress. There are 200 over 200 titles with about Berkshire, Buffett, or Munger. So the library is already pretty fully stocked. So it's a natural question. I guess the short answer is I wrote the book that I never found, which was I'm a numbers guy, I'm a spreadsheets guy, and I like to know why, and I try to get beyond into the numbers, and um, I just found myself wanting more from a financial sense. I mean, again, there's so many great books about Buffett, so but none that went A to Z chronologically. And just for example, I found myself, a couple of years ago when he still had it in the chairman's letters. He would say, okay, the MSR group businesses generated a 19% return on tangible equity. Well, I'd go to the footnotes and calculate that. And so, I wrote the book that, I didn't expect, and I don't expect, we'll see how it does for sales, but I wrote it for myself basically. And I was hoping there'd be a few more people like me out there that, really wanted to dig into the numbers. And, so I've read over 10,000 pages of material and listened to and read all the transcripts, and pulling all of that into what I hope to be is, a readable, almost 800 pages. But you can, I think, learn a lot from going narrow, but then also kind of taking a step back and examining, this broad arch over time of how Berkshire evolved, and, the decisions that Warren made, and Charlie, and just all that good stuff that went into it. So, I've kind of walked through Berkshire's history, all the way from the beginning. So I kind of view it as, Berkshire's just so special, right? I mean, it just has so many timeless lessons there that, I hope for the new, someone just new to Berkshire, or relatively new to Berkshire Hathaway, or investing, to be able to read, to really sort of get up to speed, if you will, on the company, and almost live through its history year by year, and hope, and for the existing shareholder, hope to add something to them as well. A fresh look, analyzing all the acquisitions, and almost serving as a reference guide, because the index in the book was very important. But you can go year by year, leaf through, and remind yourself of a particular year, or a particular acquisition, or something he said. So I hope it finds a place. I hope it deserves a place, I guess, on the bookshelves of existing shareholders as well.
I've seen some of the very famous value investors actually speaking highly of the book. It's Gabelli, Monish Pabrai, and Guy Spear, right? Have you? Did you just ask them to check it out and got their opinion, or how were they involved in the process at all? What's the story behind them?
Yeah, the value investing community, that the Berkshire community, I mean, it really feels so much like a family, and I think it's smaller almost than a lot of people realize. So going to those 10 meetings, or I guess 8 in person, you just kind of you come into people's, you just start talking to people, and Guy has become a friend, Monish as well, just communicating online, and then seeing each other at the Berkshire meetings, or at daily journal meetings, things like that. So I just reached out to them, and they were helpful even right from the beginning, with some of the early drafts. And but I really have to thank Chris Bloomstrand for introducing me to the Gabelli crew, because he's been going to, I think Chris has been to 20 Berkshire meetings at this point. So he has even a wider network than I do. But I feel really lucky. I mean, I've just been blown away by the support and the help. And again, I hope I've learned so much from Buffett and Munger and Berkshire, and these people have been so helpful to me. If I can give back in some way, that's really what I'm trying to do.
Well, you obviously read quite a few books about Buffett and Berkshire. What was the most surprising thing for you? What did you discover that you haven't known before?
Yeah, I mean, as the self-described, Berkshire groupie, read almost everything I think that there is, and with Berkshire, so such a long history, it's really, it's not. Maybe I'd sell more books if I said, hey, I found the secret, hidden a long time. But no, I think for me, it was really, I really came to appreciate Berkshire, and Buffett and Munger, and just the quality, and as I say in the book, they really came to master business, and but a couple of things definitely stick out. So um, when I analyzed each year, I took myself down this journey, but then I kind of pulled out and I said, okay, let me look at this over time. And you know, uh, today, Berkshire Hathaway, its largest common stock investment is Apple at almost 50% of the portfolio. But that's actually it's quite high historically, but not really. So the largest single stock investment across, and I should say, just to sort of back up a minute, I started the book in 1965 when Buffett came to Berkshire and took control. So when I refer to decades, it's actually the 65 to 74 decade, and then the 75 to 84. So that's how I've laid out the book in these decade periods. So in each of the decades that I examined, the single largest one stock in the portfolio represented no less than 23% of the portfolio in each decade. So as the decades went on, the numbers got bigger, but the percentages kind of stayed the same. So Berkshire, I guess, it was kind of surprising to see over time Berkshire has been, sort of these series of larger and larger investments, and that holds true as well on the acquisition front. The Illinois National Bank, most people know of National Indemnity, the insurance company. That's how Berkshire got its start in insurance. That acquisition in 1967 represented little over a quarter, about 28% of Berkshire's equity capital at the time of the acquisition. The Illinois National Bank, which is a bank that Berkshire owned from 1969 to 1980 when they had to divest it, that acquisition was actually 44% of Berkshire's equity capital at the time of acquisition. Those were the largest as a percent. When you look forward through the decades, in each decade that I examined, the acquisition represented no less than 15% of Berkshire's equity capital. So, the dollars keep getting bigger, but the percentages actually remained pretty constant. So Nebraska Furniture Mart, Geico, and then more recently, BNSF. It's just which tells you a lot today with why Berkshire is having such a hard time finding an acquisition, because its universe has really shrunk so much. And I've got a couple more surprising things if you want to talk about those before
Sure,
we
yeah.
delve into that. So I'll just kind of put some in a list for you so I wouldn't forget here. But there was a number of times over the years that Berkshire actually borrowed money without any clear need for it, and Buffett even wrote that in many cases. There was Berkshire really, it manages the asset side of the balance sheet completely independent, or almost independent, from the liability side of the balance sheet. So most acquisitions, or a lot of them anyway, when they come up, the company is saying, okay, we're going to acquire this company. Now, how are we going to finance it? There were times throughout Berkshire's history where it actually borrowed money with nothing in mind to do with the capital, but Buffett was confident that within a couple of years they would be able to use it, and they were successful at doing that.
And you mean the parent company or on subsidiary level?
Yeah, it was at the parent company. So in I think it was 1988, they borrowed, it was 250 million at 10%, which,
Whoa.
in context, that it was a different interest rate environment. But Buffett he writes in this letter, he says, we borrowed it at 10%. We're only going to invest it at 6.5% right now. So it's going to cost us $160,000 a week to hold this. But they were confident that, now was the time to borrow money. And so, they're opportunistic both borrowing side and on the investing side, which I just thought was really fascinating. And related to that, of course, very, very integral to Berkshire's success over time is float, insurance float, which is the money that Berkshire holds, whether it's a deposit or a loss that hasn't been paid out, and it will pay out over time, but it gets to hold. And Berkshire's, I really came to appreciate the value of insurance float and how much value it can add to Berkshire.
I've read that a lot of times people credit Berkshire's fantastic performance to this float. It's basically leverage without paying any interest on that. Do you agree with that?
Oh, without a doubt, it has been, and the key there is the quality of the float. So, and Buffett has written about this. Every insurance company knows that there's this wonderful characteristic of float, but the problem is that everybody's competing for it. So, in order for float to be valuable, it has to be at least, it has to be at an advantageous cost. And Berkshire has structured its insurance businesses to actually have a negative cost of float, which means they make money from their underwriting, which has not always been the case for Berkshire, and it's not always the case for other insurers. They write more business to get this money with the hopes of investing it, but of course today it's difficult, and it has been difficult over the years at certain times. So the key there is that Berkshire has had a very high quality float, and it's been able to grow float profitably, which has just been a double benefit. And I characterized it as rocket fuel. I mean, it really is. They had the ability to invest in safer assets, businesses and stocks, which are businesses, but safer businesses longer term, and still do better than others because they had this low cost of float. And it really, the way that Berkshire's float is structured, it is very much like equity, and it's almost counterintuitive at first, but because they have this revolving fund and it's stable, and they've structured their underwriting such that they're very prudent in only taking on good risks over time. And so that allows this float to be this pool of capital that sits there that they can put to use for the benefit of shareholders without diluting the equity holders. So it's just a phenomenal benefit of Berkshire over time, and it stays there as well. It's still today, Berkshire's float's over, I think, 135 billion. So it's just been incredible, the source of value that float has given Berkshire.
One thing I always wanted. Sorry, regarding the float, one thing I was curious about, and I wanted to research and keep forgetting. So I was under impression that insurance companies have a regulation that prohibit them from investing this float into equity. I thought it's only allowed to be invested in high grade bonds or bonds in general. Do you know if that's the case, or if the Berkshire Hathaway somehow found a way of investing in equity?
Yeah, no, there's it's mostly true. There's insurance is a heavily regulated industry, and for a reason, right? I mean, it's because the insurance commissioners and regulatory framework is set up to protect the customer, right? They want that capital to be there if it's needed to pay out claims. So there are restrictions on how much. It's just like banks, very, very similar to banks. Insurance companies are that they have to hold so much capital in relation to the premium volume, as well as the losses that they've accrued. So, and again, it's almost counterintuitive, but Berkshire has done far better than others in the insurance business because it has been conservative. It's almost, they've been able to be more aggressive because they've been more conservative. So, for example, um, it has been sometimes in the single digits, but usually in the low double digits. The ratio of premiums um, to capital that Berkshire has written over time. So it's not uncommon to see some insurance companies writing 2 or 3 times, two or 300% of their equity capital in premium volume. And so when you have that high level of business basically going through your company, all of that float has to be invested in very safe assets. So they have to be invested in bonds. Where Berkshire has such a low volume, it has way more capital than it ever needs, and it's purposely set up that way to be super safe, which allows it to do things like uh, invest most of its portfolio in equities, or even some people don't know this. National Indemnity owns the Burlington Northern Santa Fe Railroad. The insurance company owns a whole railroad. Berkshire
Oh,
put it
wow.
under there. So yeah, it's just it's really neat, and you see these examples over time of how Berkshire's conservatism actually allows it to act more aggressively and ultimately do better over time.
That's fascinating. I think you answered my question about that. That I didn't realize that about the ratio of premiums to assets are the reason actually. But that makes sense. So I'm sorry I interrupted you. There was some another interesting thing you found.
Oh yeah, no, it's okay. It's, yeah, there's so much to Berkshire. It's really telling this life story, right? Um, so another interesting thing, and again, just focusing on the Buffett era, is is Buffett's entrepreneurial spirit. So I don't, others have covered his early life and covered, his entrepreneurial ventures, whether it's the selling Coca-Colas at a markup or delivering papers or golf balls or pinball machines. I don't get into that, but you can see this entrepreneurial spirit in a lot of what Berkshire has done. He has really pushed Berkshire forward in many cases. In the early days of building the insurance empire, Berkshire formed a number of these home state insurance businesses, which were just simply insurance companies that were set up in each individual state to write business just in that state. So you have them in Minnesota, you have them in Texas, Nebraska, Iowa, and not all of them were successful. There was a couple. Lakeland Fire and Casualty was actually it was formed in 1971, and then it was closed in 1982. The insurance company of Iowa was formed in the early 70s, and then it was merged into Cornhusker Casualty Company, which was another home state company. And so it was really interesting to see, this entrepreneurial spirit just continuing at Berkshire over time. They bought they bought this and home and auto insurer in Cook County, Illinois, which was the Chicago area. Phenomenal success. They tried to replicate it in Miami and completely failed.
Hmm.
They ran into reporting issues. The accounting wasn't getting to them quick enough to have that feedback loop to be able to make better decisions, and they ultimately closed it down. Um, more recently, coming closer to the present, Buffett had Geico offer a credit card to its customers, reasoning that good drivers would translate into good credit risk. Completely wrong. He again, Buffett. I mean, you have to give him credit. He writes about his failures all the time, and he said Geico management told me not to do this, but he was the one that pushed them forward, and they ultimately lost. I think it was $50 million on this, but he's really been the driving force. And again, with Geico, over the years, just saying, you know, build the business, look to the future, look forward 10 or 20 years, let's continue to build market share, forget about today's profits. And so he has, in many cases, I think, whether it's explicit and we know about it, but probably many times behind the scenes, pushed Berkshire in many ways to become more entrepreneurial, to really just try things and take calculated risks. I mean, that's ultimately what they've done over time.
In regards to those homestead insurance companies, do you happen to know if there is advantage of opening individual homestead insurance company versus getting established brand insurance, just getting licensed in particular state?
Yeah, I mean, I guess, there's no, and Buffett writes about this, that there's no, insurance is an open book. I mean, it's a commodity industry ultimately. There's an ease of entry, and you really don't have any kind of brand. I mean, outside of, today's Geico or, some of the ones that we know. But if you're a business owner looking for a D&O policy or, some other business casualty insurance, how much does brand really matter, right? So um, I think many of these were formed just for that legal, they had to be formed in other states for certain purposes, but um, the, the form, I guess, was less important than just the fact that they were doing these things, and they had a workers' comp business in California, and just all these things that, if it necessitated a new entity, they would just create it.
Gotcha. Makes sense. Oh, did we cover all the interesting things you found? Surprising
Yeah,
things you found?
I'll give you a couple more. I know, um, just a couple. So it was interesting to me to see, Berkshire doesn't care about growth so much as a quality business.
Yeah.
So See's Candy, right? It's grown over time, but it really has faded. Um, Scott Fetzer was another one that when Berkshire bought it in 1986, doubled its revenues. It was a huge acquisition. Literally, the business has faded to a footnote in Berkshire's financials over time. I think it last appeared in 2002 or 2003, and you see this over time. So See's, the footwear businesses, even Shaw Carpet, which was a $5 billion revenue business, and even Marmon with over 130 subsidiaries of its own. Really to have a conglomerate sort of just shrink uh, relatively compared to Berkshire's other businesses as a whole, it was fascinating over time.
It's interesting. I
Yeah.
remember somebody asked that question about C's. There was a annual meeting, and some German guy asked this particular question. He said, like, why didn't you invest in C's Candy so it become next Cadbury or something, and instead basically cash cowed it and let it stay small? I don't remember the answer. I think he dodged the question, but yeah, I do remember that was some kind of interesting approach.
I think he did answer it because, it's one of those ones, and I think it's been brought up over time. He said if they could find anything close to what Seas was earning, if they could expand and earn anything close to what they had, they would do it in a heartbeat. And they tried. And again, that was another example of this entrepreneurial spirit. They tried to open up new stores. They tried it on the East Coast. It just didn't stick. It really was a niche business that had this brand, and people loved it and still love it in Southern California, but it just could not travel well. And you know, so they would have done it if they could have, but they just couldn't. And some of these businesses just can't grow for whatever reason, or maybe it's in a niche market, whether that's brand or product that they're fine with that. I mean, See's Candy has earned Berkshire. I think the number's probably up over 2 billion now. I think it's well over 2 billion pre-tax since that initial $25 million purchase price in 1972. And that's okay, right? They just take the cash and they reinvest it in other opportunities. So growth by itself does not necessarily add that value.
Yeah, and again, I interrupted you because you wanted to say there is some other interesting stuff.
Yeah, and again, but then we'll delve into the book, some of the history. But yeah, just I guess just one last thing was, this barbell strategy almost, of anything, anything, if they have cash or excess capital, it has to be in the safest. It has to be in treasuries. Buffett doesn't care what the yield is, and yet they'll do, sort of quote unquote the risky things of buying whole businesses or investing a ton in stocks. And it's this either or approach. They don't try to reach for a yield or go in the middle, or okay, we're gonna like go out in the yield curve on bonds. It's ultra safe or ultra long term. And I just found that really fascinating to see. It's wait patiently, completely safe, or all in. And Charlie's really talked about that over time. Wait for your opportunities. So
Yeah, I remember Charlie made that. He told a story how one of his friends gave advice to students how to get rich. He said, like, keep $10 million on a checking account all the time in case opportunity arises, something like that. Anyway, so why don't we dig into the book a little bit? Let's go all the way back to the origin of the Berkshire Hathaway.
sure, no, it's a fascinating story. And so it's really uh, from a 30,000 foot view, it's almost an accident that this history exists, right? Because the Berkshire of today is so different, 180 degrees different than what it was at the beginning. But because it grew out of this textile business, this history has remained. And I have to credit Warren, for having me go back this far, because when I first I started the book in um, like I said, he arrived in 1965, and I said, I'm going to go back to 1955, look at the decade before, and then work forward. Well, I sent Warren that chapter, and he, to my surprise, wrote back and said, glad you're writing the book. It'd be interesting to go back and take a look at Berkshire's temporary profitability in the World War II period. And so I said, okay, well, if he's asking me to do that, I'm obviously going to do it, right? But as I started going back, I said, well, geez, why don't I just go all the way back, right? And so I found myself uh, researching the early textile industry. And behind me here is on that top shelf behind my book is a bunch of that's sort of my Berkshire history shelf. A lot of cool books written about the textile industry and the evolution of the industry in general, but then the United States. And so I briefly, the first chapter is about the origins of the textile business, and then how it transferred to America. But so briefly into, how the textile business came from England. This guy, Samuel Slater, basically stole the technology. He went over there, learned all he could, got on a boat, snuck into the United States, which again, even though this might not be relevant to today, I mean, nobody's looking to open a textile mill here today, but just the fact that, the modern day equivalent might be, trade secrets from, China, or, you can't stop this flow of information, right? I mean, it's human knowledge that gets created, and it's going to find a way out. And so this textile knowledge came from England. They get set up in the United States, and it's in Massachusetts. It's in New England, because they have these strong flowing rivers, and it allows the power to be transferred to the mills, right? So that was like the late 1700s that the industry started. But Berkshire's history, just to get back to Berkshire's history starts, and I have a graph, and if your listeners, your viewers are interested in checking out, I have a blog which is also sort of a companion to the book, theoraclesclassroom.com.
And by the way, that's remarkable. I've never seen so much information about Berkshire, and I was fascinated to go through those archives. You did a lot of service to people who are the nerds of the subject. Sorry, let's get back.
No, thank you. Yeah, I appreciate that, because I was originally a companion to the book. I said, well, geez, I need a website for the book. And then it was like, well, why don't I just put all of this information that I'm coming across, organize it? And there's a lot out there, but just to kind of put it in one place. So yeah, check that out. And I do have this timeline out there, which I'm referring to now, um, the beginnings of Berkshire. But you have so Berkshire Hathaway, right? 1955, Berkshire Fine Spinning Associates merges with Hathaway Manufacturing. Hathaway Manufacturing has this parallel course from the late 1800s until it merged with Berkshire Fine Spinning in 1955. Berkshire Fine Spinning has probably about a dozen predecessor merged companies that ultimately formed Berkshire Fine Spinning in 1929. One of the earliest was the Valley Falls Company, which was 1839. This was Chase, the Chase family. But there's all these other individual plants and individual mills, which again, by the way, sort of plugging the website, I was able to go back and find old Moody's manuals from the 1920s in some cases, and see, okay, here's capital stock, here's the number of spindles they have. I mean, it was just really the directors. It was just fascinating to see all this information that was out there. And so all of these individual mills that ultimately merged with Berkshire Fine Spinning and then to make Berkshire Hathaway became their division. So if you're looking at the 1955 report, for example, they'll talk about their King Philip division or the Greylock division. Those were actually individual mills that merged with into ultimately forming Berkshire Hathaway over time. Then some of them closed as well, but that was the origin of Berkshire Hathaway. It has this really interesting lineage, not unlike an ancestry of sorts with a person. So that was the really early history of Berkshire. And I thought I'm glad I did it. I'm glad I went back, and a lot of the again, I'm hopeful that this book will add value, not unlike, I hate to even compare it to security analysis, because security analysis is the Bible of value investing, but just using these older examples to illustrate modern timeless concepts, whether it's working capital or plant, property, and equipment, and the depreciation and how depreciation is real, and obsolescence and competitive factors and things like that. It's that story is all there in the Berkshire early history, and it's instructive to sort of walk through that early history and learn about business in a meaningful way. And it's tangible, but it's less tangible than running a business yourself or something today. But it's pretty straightforward, and I think people hopefully will learn a lot from that early history.
In regards to what Buffett asked you to check the profitability of the Berkshire, what did you find there?
Yeah, so again, it's really interesting. These mills, and I walk through the history of textiles in New England, and then as the shift from New England. So it started in New England because of the rivers providing the power. Well, once the southern states, once electrical power became more ubiquitous and cheaper down south, the South kind of became the dominant producer of textiles. And then you have this influx of foreign competition. And so, these mergers, many of these mergers were precipitated by industry struggles and the competition. And it was just really this tick downward over time of mills going out of business, things like that. And you can see that in the profitability. And then all of a sudden, World War II hits, and there's a need for the cotton to clothe soldiers, and then they get into rayon and other synthetic production, which these mills basically the mills one that so many went out of business that when this boom came, they were there and they could just make this huge amount of profit. And the North in particular, the South ultimately gained an advantage in as well, but the North in its evolution went from basically coarse grade textiles to fine grade textiles. And so while the South was still sort of learning to make these fine grained, weave these fine fibers, um, the North sort of had this temporary advantage in doing this with rayon and synthetic fibers, which were fine, these fine fibers. So it's really temporary. I mean, they did things. They did things like uh, uh, make textiles that ultimately went into tires and billiard balls, and again for the war, hammocks and parachutes and things like that. But it was temporary, and so you have this sort of spike in profitability, and then it's just this resume the path downward into terrible economics that ultimately attracted Buffett to Berkshire.
And when did he buy it? 60s or 60 what?
He started buying in 1962, and then of course, famously, it was 12 and 12.5 cents that Seabury Stanton said he was going to pay for the tender offer. Buffett was ready to give up his shares, and then the offer came in at a little bit less, and Buffett said, "Well, nope, I'm not selling. I'm gonna buy all of this up." And the history of 1955, when Berkshire Fine Spinning and Hathaway merged, to 1965, when Buffett came in, is really interesting. The company had a series of these. They would close mills, and they actually, so that freed up working capital, and they actually returned about half of the capital to shareholders over that period. So the business shrunk in half, but it was almost surprising to see the degree of rationality that these managers displayed. I mean, ultimately, it took Buffett to come in and say, well, geez, we don't have to stay in textiles. Let's buy an insurer. Let's buy a bank. And but it was interesting that they actually returned capital to shareholders in the form of dividends and buybacks even before Buffett came onto the scene.
So basically, the contribution that Buffett made, it's he stopped returning cash to shareholders and instead started investing it. Is it fair to say?
Yeah, so when Buffett first bought into Berkshire, it was one of many investments. He was running his partnership, and it was just one of many investments. And so ultimately, when he took control, which was in May of 1965, it was another pool of capital for him to invest. And so it was 1969 that he closed his partnership. But so you have this period of time between when he took control of Berkshire and when he closed his partnership that to him, it was just another pool of capital. But almost right away, he starts making a difference in the company, and that it's clear even right from the first letter to shareholders that he writes that I won't go too deep into this, but some of the accounting that they would do when they would write down a plant, for example, today you'd have to write that through the income statement. It was just a direct hit to equity, and there was really no mention of it in the report. But when he comes in and starts writing these letters, it's right there up front. He says, "Well, we wrote this down, and so it looks like our profitability is higher. We didn't have to pay these taxes, but if we had to pay taxes, our profits would be this." And so just the quality of communications started almost immediately. But then you have 1969 buying, or 1967 buying National Indemnity, which formed the foundation of the insurance empire that is today. You have the Illinois National Bank in 1969, which interestingly, again, 44% of equity capital at the time of purchase. So he was not shy about, and they actually borrowed some money to make that purchase. He was not shy to take Berkshire's balance sheet and essentially not leverage it, but use it to acquire other better businesses. And during that time, he bought Washington Post stock and things like that as well. So
Did they sell the bank? Because I remember vaguely that they talked about it, but then they just stopped.
yeah, it was almost immediately after they bought it, the Bank Holding Company Act rules changed, and they had 10 years to divest it, and so they had until
Gotcha.
1980 to divest the bank. But oh man, what a fascinating story that bank was. Really, really high quality bank. I suspect owning that bank from 1969 until 1980 really instructed Buffett on how a well-run bank should be run, and gave him an insight into what good banks look like. And you see that over time. I mean, Berkshire has had a significant investment in banks over its history.
So we now went from 55 to 75, right? So what happens in our subsequent decades? Like, what are some highlights?
Yeah. So yeah, I guess so that was like the 65 to 74 decade, which was 10 years. And so 75 to 84, you have again almost this but Buffett almost couldn't help himself finding a cheap business. And so I live in Derry, New Hampshire, but right next door is Manchester, New Hampshire, and uh, Berkshire bought the Wambeck Mill in Manchester, New Hampshire. It was below book value. In fact, when they put it on the books, it didn't even have any fixed assets on the books. I mean, they had fixed assets, but when they put it on the books, there was no fixed assets depreciated. It was a bargain purchase. Almost immediately, fails, and they ultimately close it down. They were able to squeeze some cash out of it. So the textile business is still there. They're still trying to make a go of it. But then you have other purchases like the Buffalo News, and in this decade, so Berkshire's almost this combination of the Berkshire Hathaway, diversified retailing, and then blue chip stamps. So these are three entities that, um, and actually during this decade, Buffett and Munger got in trouble because again they were just buying things. They were buying stocks and businesses with whatever capital they had available, right? So um, they Berkshire bought into blue chip stamps. Well, blue chip stamps also owned shares in Berkshire, and diversified retailing also had shares. So they created this web that ultimately they were investigated by the SEC, and but it was, I mean, it was above board, but it really looked like it was something nefarious going on. So during this decade, they're successful in merging diversified retailing and blue chip stamps into Berkshire Hathaway. And so See's Candy, its immediate parent is actually blue chip stamps. Same with the Buffalo News. So, um, but these better businesses, and of course, newspapers today are bad businesses as a class, but they were the powerhouses of yesteryear. And so you see, the Buffalo News, which struggled. I mean, it's these businesses over their history, we tend to have sort of the end story today, but the Buffalo News struggled before the Courier Express closed. Buffett could see that it was going to become a one newspaper town, and it ultimately did. But there were struggles there. Seas had its own struggles with inflation and things like that, cost pressures. So it was not a smooth upward trajectory, but in general, you start to see Berkshire, moving more into insurance and buying these better businesses, which ultimately start to uh, overshadow the textile business.
What was included into diversified retail?
Yeah, so that was I think it was formed in the mid '60s by Buffett, Munger, and Sandy. I think it was Sandy Gottesman, to buy Hawkschild Cone, which was a second, third rate department store. That was ultimately sold, and then they bought Associated Retailers, Associated Cotton Shops, which had a number of different stores. Um, which again, and this is it was just fascinating to me. I'm lucky to be so close to Boston. I actually travel to the Boston Public Library, and they have wonderful, wonderful resources. Um, but to my surprise, diversified retailing had a public debenture, and so they had to file public reports. And so on the Oracle's class on my blog, I do have in the archive section some annual reports of diversified, so you can see these businesses before they merged into Berkshire. And so that was that entity. It sounds like this. It was almost like they were going to create this conglomerate of sorts. But it was almost, diversified retailing sort of became concentrated retailing, and then they just put it into
Hmm.
just kind of simplified things and rolled everything up into Berkshire Hathaway. So the 75 to 84 decade, you kind of see this, you know, moving capital into better businesses, growing the insurance businesses, and almost this housekeeping of sorts of cleaning up some of these loose ends. And then, in the beginning of the next decade, they closed the textile operations completely. So it's sort of, setting sail with these better businesses that they acquired.
And now we're at 85, 94.
Yeah. So this is in some ways kind of one of my favorite decades. They're big enough. They're big enough where they're starting to get recognized. Buffett's getting some more press. They have enough capital to kind of do some of these cool things, buy whole businesses, buy some bigger businesses. The textile operations, that they only last until technically 1986, I guess, but 1985 is when they say we're shutting them down. And so this decade, you see in 1986, Berkshire buy Scott Fetzer, which I think I mentioned at the outset, nearly doubled its its revenue base. A huge acquisition, which of course Scott Fetzer was the parent company of Kirby, which most people know, World Book, Campbell Hausfeld, which they make compressors, as well as a whole host of other sort of niche industrial products, things like that. Um, but Scott Fetzer and Feckheimer, which is a uniform manufacturer, these two businesses, it was so fascinating to see. They came to Berkshire almost like today as a port in the storm, where both of them went through these, attempted or actual leveraged buyouts or private equity is what we might call them today. But when you look at the businesses, they earned great returns on capital. I mean, Scott Fetzer was earning, Berkshire got, I think, a 25% going in return on that investment. Beckheimer was earning 50% on capital. So great businesses. It was so surprising that they were just discarded, but Berkshire found a home for them. And then, of course, you have during this decade, Berkshire buys into Coca-Cola. Those shares, that cost basis today remains the same. It, in retrospect, was a mistake to get into shoes, but this was the beginnings of the shoe business, the shoe group, with Lowell Shoe and H.H. Brown, and then Dexter, which he later said was a mistake. And then, just organically, Berkshire starts going into the supercat business and insurance, and really saying, okay, I can take, Buffett realized that they could, unlike like the home state companies that we talked about, where they don't really have any kind of marketing advantage, for a reinsurer or for a big insurer, your reputation on the business side will get out there, because these you have to be around to pay the bill. And so Berkshire said, well, geez, we're going to take our conservatism and this high level of capital that we have, and we're going to market it and say, hey, if you have a big supercat loss, we're going to be able to pay it. And they were able to leverage that in a sense into that business.
What's the next decade? We go to 95 to 204.
Yep, 95 to 04. That's the big one there. Well, the two big ones. they sort of round out the insurance empire in this decade. So you have Geico that they bought the other half of in 1996, and then in 1998 they buy Gen Re, which was a major uh, U.S. and international through a subsidiary reinsurance business, which stumbled at the beginning and actually looked like a mistake for a while, um, but ultimately they were able to turn that around. And then you have this whole host of other acquisitions during this decade. This was, of course, the run up and the dot-com boom, of 25 years ago, 30 years ago. And so they scoop up all these great businesses, Johns Manville and Fruit of the Loom and Shaw and Justin Industries, Dairy Queen. And, there's a ton of acquisition activity during this decade that really bolsters the growth trajectory of the non-insurance businesses.
Is Fruit of the Loom a good business? Because I'm thinking of it as like, why is it not repeating the history of shoes, where there are cheaper manufacturers in foreign countries?
Yeah, and that's a fascinating case study. I don't know, and we don't know. I guess outside of it'd be great to have this information. It's such a small subsidiary that we don't know how it's doing, but it's a great question, right? I mean, it's a textile business, but that acquisition. So I don't have any kind of insight into why that didn't happen.
Mm-hmm.
Maybe it was the brand, maybe it was their distribution network. I mean, you think about it's underwear, right? So it's and sort of related small clothing that maybe it wasn't as heavy as some of these other things that maybe it was the true. I don't really have a good answer. I don't want to speculate, but that acquisition, it was originally a distressed debt investment, and then Berkshire went and offered to buy the company, and their one condition was that this guy John Holland would remain as CEO. And so, kind of like Geico in its early days before it got in trouble, it had this core business that was doing really well, and then management just kind of strayed, and Fruit of the Loom did the same thing. And so, the former CEO left, they ran into a bunch of trouble, and Berkshire bought it, installed the guy again, and just brought it back up to profitability.
And it wasn't cheap. I believe it was like 900 million, something like pretty high. But anyway.
Yeah, you're right. I don't have an exact figure, but that sounds about right. And many of these businesses, it wasn't, you start to see this evolution over time. So I mentioned Beckheimer and Scott Fetzer earning, well into the double digits return on capital. These businesses, there were certainly many that earned really, really good returns on capital, but you start to see the purchase prices start to elevate, and the going in return that Berkshire gets starts to come down, because they're paying more for these businesses. But they're okay, if it's a good business that's throwing off cash, they're okay buying them.
So let's move to the next decade, 2005 to 14.
Yeah. So again, sort of just wash, rinse and repeat, right? You start to see these bigger acquisitions. Berkshire buys ISCAR, which is the first, sort of major overseas acquisition. Marmon, another one. So, Scott Fetzer was 1986, a little mini conglomerate of itself. And then you see Marmon, a couple decades later, literally, I mean, it was a, Marmon on its own, it was private, but huge business, right? $9 billion. They acquired it in multiple tranches, but the dollars get bigger, the businesses get bigger. And Marmon, when Berkshire bought it, was I think 120 business conglomerate in its own right, swallowed up by this whale of a growing conglomerate that is Berkshire Hathaway, um, uh, you see, another big business of the prior decade, but they expand upon it in this decade, is the energy business. So they buy Mid-American in 1999, and they start to piece on, other components of this, NV Energy, for example, AltaLink, which is a distribution business in in Canada, um, BNSF, sort of in that utility-like category that they buy in 2010. So the the businesses just get bigger and bigger, and of course during this decade we have the 2008-9 Great Recession, credit crunch. You see $14.5 billion go out over the course of 2 weeks. Buffett lending to all these businesses really quickly, and he studied them for so long. I mean, Berkshire, for example, lent $6.5 billion to Wrigley. Buffett and Berkshire actually owned some Wrigley stock back in, I think it was the early days, 60s or 70s. So he was familiar with the business, and he just watched them over time, and he was able to make these quick decisions. But he's able to do this because he studied them, and because Berkshire had the cash. They were a net supplier of capital to the market during this time.
Yeah, that's fascinating. They made pretty good returns back then. And we're 14, and I think that there is a 5-year period that you discussed later, right? For
Yep,
15
So
to 19.
I've gone all the way up. So that was there. In the book, I pause and I do a 50-year recap and kind of uh, walk through the 50 years and the evolution of the company and everything like that. And then we start the next decade, and it just kind of luck happened. It's half of this next decade that we're in, and so 2015 to 19, again, you have Precision Castparts. You see um, Berkshire partner with 3G to buy Kraft. So you have Kraft Heinz, and then of course, some of these other bigger deals like acquiring a significant stake in Apple, um, and then just organically, in this short period, it was over $70 billion that they invested in capital expenditures. Probably half of that was depreciation expense. They're just replacing, but half of it was growth capital. But you see this evolution again towards bigger businesses, bigger investments, in dollar terms, and this continued evolution of operating businesses instead of being dominated by stock market investments.
So
Um,
when you look at the Berkshire, let's say, post Buffett, what do you see? Like I'm guessing he's 90, I think, right? At some point, something might happen. Maybe he'll resign, but I don't think he would. But what do you think? What are the prospects of Berkshire post him?
yeah, I mean, I think it's all in context, right? I mean, so functionally, he's 90. Charlie Munger just turned 97, and the way that it's set up, just from sort of a financial structural standpoint, is Buffett's estate will continue to own his Berkshire controlling stake. That will get metered out over the next 10 years to foundations. And so really, and I have a chapter in the book about Berkshire after Buffett, and kind of speculate a little bit on this, but um, Berkshire will essentially, even if it just grows at 7% a year, will double over the next 10 years. So it'll be huge. I mean, it should be a trillion market cap, easy, um, after he's gone. And so to be able to, break that up, or Wall Street come in and sort of feast on it, probably won't happen. One for its size, but then also you're going to have, big insiders, Bill Gates, who just stepped down from the board, but Gates owns a ton of stock, and you have these old families that own Berkshire stock and others, longtime shareholders, really the focus I think will shift to the shareholders, but Berkshire I think will continue to do well over time. But I have a chart in the book about its the uh, the incremental um, outperformance of the S&P over time, on a 10-year rolling basis, and you see it. It's comes down year after year and year, and that. But even if that's small, right? Even if that outperformance is small, there will still be opportunities. So that small advantage will compound over time. There will be opportunities to lend money, just like they did, 10 years ago, 12 years ago. Um, there'll be opportunities to buy big businesses, do add-on acquisitions. So I think as long as you realize that it's a half a trillion dollar equity base is not going to grow at anywhere near the rate that it did in the past. I think using that metric, it will do well over time.
Do you think it would outperform S&P? Because it doesn't seem like they did that well in the past decade relative to the index.
No, and Buffett's even said that as in up markets, Berkshire will underperform, and we've seen this huge up market. So, I don't want to speculate. I mean, you look at, just broadly speaking, the S&P as a whole, and then you look at Berkshire, and the Berkshire has net cash. It has extremely well capitalized, extremely good businesses. The S&P, so from today, I mean, I'm obviously biased, and I do own, and I'll continue to own Berkshire, but you have to have reasonable expectations on that. So I would rather own Berkshire, but and I think, maybe this. I think Buffett's even said, I know he's touted the S&P as a perfectly fine alternative, but it's not as obvious as it was, 10 or 20 or 30 years ago. Back then that differential was so wide that it was almost obvious. But it will certainly be interesting, and I sort of speculate that, and you see this over time. I mean, the last just the last 5 years, Berkshire generated something like 40% of the capital that it ever made. So these numbers are just huge, and so it's ultimately going to have to start returning capital to shareholders, and we've seen that over the last couple of years, and this 2020 will probably be over 20 billion, I think. But so I speculate that maybe there will be a small, relatively modest, say 25% of normalized earnings dividend that will sort of provide this relief valve of sorts. And then maybe they'll have, if cash is building up, have some sort of special dividend from time to time. But that will also become a lever that management can pull, that if a large acquisition happens, they can fund it with a little bit of debt, pay down that debt, and then continue to sort of pay out earnings. So I think they'll do well over time, and I don't think it should be broken up, but the cries will become much more vocal and louder post Buffett, for sure.
Yeah, that's what I expect too. So, what are some important lessons do you think you've learned following Buffett all these years?
To nail down a few is tough, but when you look at the way he thinks, thinking long term, he really thinks in not even year periods. He thinks decades at a time, and I was struck. For one example is he said he was talking to the Financial Crisis Inquiry Commission in 2010. They came to see him and say, geez, explain this Great Recession that we just had. And in that interview, he says, if I was in control of BNSF, which a sort of sidebar lesson is, even though he owns it and does control it, he really thinks of it as, that manager's business, completely hands off. But the lesson of thinking long term, he says, geez, if I would not hedge fuel prices, because if I own this forever, in an eternity, I'm going to be out the net frictional costs of the hedge. And so just all these little things, like they really think very, very long term. And I think that time frame, that framework is so important, especially today, with such short term thinking. Same goes with, I mentioned Berkshire owning, nothing but treasuries, or, businesses basically. This default risk ultimately becomes very meaningful over time. And so you want to invest in something that's completely safe if you need it. Another lesson, I think, is, thinking in the way I lay out all the acquisitions over time in the book is through thinking in terms of total return on capital. And so Berkshire, with the exception of, say, the utility businesses, looks for businesses that don't need debt. And so looking at acquisitions, looking at your own investments, I guess, as 100% equity financed, what is the actual basic cash generating result of the asset that I'm buying, irrespective of any financing that might juice that return. It's really helped me think about businesses differently, because you just remove this whole component of return on equity might be just juiced up by financial engineering. And related to that, you look at when you're looking at a business, not to look at profit margins. Profit margins in isolation don't tell you enough, right? So an extreme example would be their McLean subsidiary, which earns 1% pre-tax, and you say, well, geez, that's a terrible business. It's gotten much tougher over time, but when Berkshire first bought into it, it was earning like 15% on capital, because it had this huge amount of revenues, this huge capital turnover that translated that small profit margin into a meaningful return on capital. And you see another sort of quick example would be See's Candy and Flight Safety, their flight training simulation business, where the operating margin and I have this in the book, the operating margin at Flight Safety is something like 30%, 29 or 30%, and See's is, only earning 21%, but Flight Safety requires, it only generates about a quarter, quarter dollar, 25 cents of revenues per dollar of assets. I've used assets because the information wasn't available, but See's, even though it has a slightly lower operating margin, is earning $3 per dollar of assets. So it just, the return on See's is just through the roof. So really just trying to get that full picture and looking at the business as a whole.
Let me ask you this. When you mentioned return on capital, did you mean return on assets or return on equity?
So return on capital is the total capital that the business employs. And so that's equity capital and debt. So there's two ways of going about that capital calculation. One, you can start with the assets and say, okay, I need this much cash, this much receivables, this much plant. Or you can take, which is sometimes simpler, and just say, okay, total equity, total debt, and then you might subtract out intangibles to get a tangible capital number. But it's really, you're looking at the business as if it were 100% equity financed, because you might have, if you have two businesses and they're both earning a 20% return on equity, if one business has 2 times leverage and they're borrowing, the same as their equity base, the underlying business might only be earning 10%. They're just using, financial engineering basically. So Buffett, it's so key to just look at the quality of the underlying asset first, and then look at how it's financed.
So it's like a ROIC ratio, right? That's what we're talking about.
Yeah, ROIC,
Right. Gotcha.
return on invested capital. And return on assets is, and I used assets in that example because I was taking the information from, again, as the businesses sort of literally faded to a footnote, you lose all of this wonderful information over time. And so I was kind of forced to use assets as sort of a proxy. But even if a business was 100% equity financed, you're still going to have these spontaneous liabilities like accounts payable and accrued expenses and things like that will modestly improve that return on assets into a better return on capital.
Got it. So Adam, so obviously people who are watching this video right now are primarily big fans of Buffett, but there are some people who are not really into investing, and maybe they just stumbled incidentally. You run a fund yourself, and I don't want to ask your opinion on investing tips because you might have a liability. But what did you learn from Buffett? What do you think he would advise to regular Joes and Janes how to invest their money?
Mm-hmm. Yeah, I think the first thing is to really decide who you are, I guess is the way I'd put it. Buffett says, if you're interested in investing, if you have the aptitude and the time, you're a know something investor, that's one thing, but it's okay to be a know nothing investor. And I think he even used that word, a know nothing investor. And it's not an insult. In fact, he says that, if you don't have the time, the interest and so forth to do it yourself, just broadly diversify, buy over time, and basically participate in the growth of America or the world. So deciding who you are, it's okay not to look at individual businesses like I do or we do. That's what we find interesting and fun, but it's okay not to. But I think it's important that even if you're just taking that hands-off approach, always remember that the ultimate source, don't forget that you're buying or lending to businesses, right? So, it's not just a stock ticker that moves around, and you have to realize that in a portfolio, the ultimate source of your return is a business. Even if you're lending to it, you're buying a bond. You have businesses. In some cases, some companies have multiple different business lines, and then you have a stock, and then that stock might be in a mutual fund, and then that mutual fund is part of only a piece of your portfolio. So it's almost this pyramid. By the time you get to the top and you're looking at your portfolio, it's almost you almost forget that the ultimate source is a business. And I think if people can always keep that in mind, whether you're digging into the details or just taking a broader based approach, that's really the way to think about it.
Thank you, Adam. I know the book is available on pre-order right now, right? And I think it's going to be shipped on April 13 or something like that.
Yeah, interestingly, I learned I want to do a little talk or something about the publishing process. I learned so yeah, April 13th. Books are only published on Tuesdays, I learned. So April 13th is a Tuesday. You can pre-order it on Amazon. International investors, international buyers can go directly to the Harriman House website if it's not showing up as. There's a quirk that if you're outside of the U.S. or the U.K., it might show up as out of stock, but you can always go to the Harriman House website to buy it directly.
That's fascinating. I'm personally looking forward to it, and I'm also almost gonna start counting days to April. Let's see. Well, thanks again, Adam. Best of luck to you, and let's stay in touch.
Yeah, thank you, Azra. This was fun.